Today, we're diving into a popular topic in personal finance and retirement planning, the 4% rule. You might have heard about it if you're interested in financial independence or early retirement, but what exactly is the 4% rule, and how can you use it in your own financial plan? In this video, we'll break down what the 4% rule is, where it came from, and how you can use it to make your retirement dreams a reality. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. So, what exactly is the 4% rule? The 4% rule is a financial guideline that suggests you can withdraw 4% of your retirement savings each year without running out of money for at least 30 years. This rule gives you a rough estimate of how much you can spend annually from your investment portfolio after you retire. The 4% rule helps you determine how much you need to save for retirement. If you know you can safely withdraw 4% per year, you can calculate how much you need to save to support your desired lifestyle. It's a simple way to figure out your magic number for financial independence. The 4% rule originated from a study by financial planner William Bengen in 1994. Bengen analyzed historical market data to see how much a retiree could withdraw from their savings without running out of money. He found that a 4% withdrawal rate was sustainable for most portfolios, even through economic downturns. Knowing the history of the 4% rule gives you confidence that it's based on actual market performance, not just theory. This rule has been tested through various economic cycles, so it's considered a reliable guideline for retirement planning. To figure out how much you need to retire, start by calculating your annual expenses. Once you have that number, multiply it by 25. For example, if you want to live on $40,000 a year in retirement, you would need $1 million saved, because $40,000 is 4% of $1 million. This calculation gives you a clear goal to aim for. Knowing your magic number provides motivation and a specific target for your retirement savings. You might be wondering, why 4% specifically? Bengen's research showed that a balanced portfolio of 50% stocks and 50% bonds provided enough growth to support a 4% withdrawal rate over a 30-year period. The mix of growth from stocks and stability from bonds helped the portfolio withstand market fluctuations. The 4% rule assumes a balanced approach to investing, which is key to ensuring your savings last. This balanced portfolio allows for growth, helping to offset the impact of inflation, while also providing stability. One of the benefits of the 4% rule is that it's designed to account for inflation. Each year, you adjust your withdrawal amount to keep up with rising costs. For example, if you start with $40,000, you would increase this amount slightly each year to match inflation rates. Inflation erodes purchasing power over time, so it's important to adjust withdrawals to maintain your standard of living. The 4% rule includes this adjustment, making it a more realistic approach for long-term retirement planning. The 4% rule assumes a certain average return from your investment portfolio, typically around 5 to 7% after inflation. Market returns can vary, but over long periods, a balanced portfolio has historically met this benchmark. It's important to understand that the 4% rule relies on historical market returns. While there's no guarantee of future performance, a balanced portfolio is generally recommended to help maintain growth and support your withdrawals. One of the biggest questions with the 4% rule is, what happens during a market downturn? If the market takes a dip, your portfolio value may decrease, which can be concerning if you're withdrawing 4% each year. The 4% rule is designed to handle market ups and downs, but you may consider reducing withdrawals during tough years or holding a cash buffer to avoid selling investments at a loss. Some experts recommend adjusting your withdrawal rate based on market conditions. For example, you might withdraw a bit less in a bad market year or increase withdrawals during strong years. Being flexible with your withdrawal rate helps protect your portfolio from being depleted too quickly. This dynamic withdrawal strategy can add a layer of safety, especially if you're planning for a retirement longer than 30 years. To implement the 4% rule, your portfolio should ideally have a mix of stocks and bonds, typically 50-50 or 60-40. This balance aims to provide both growth and stability, which are essential for sustaining withdrawals over decades. A well-balanced portfolio helps manage risk while allowing for long-term growth. By diversifying with both stocks and bonds, you're better positioned to handle economic cycles and ensure your savings last. Remember that not all withdrawals are tax-free. Withdrawals from traditional IRAs or 401(k)s may be subject to income tax, while withdrawals from Roth accounts are tax-free if certain conditions are met. Understanding the tax implications of your withdrawals helps you manage how much money you actually have available to spend. It's a good idea to work with a financial advisor or tax professional to create a tax-efficient withdrawal plan. The 4% rule is based on your savings, but don't forget to factor in other income sources like Social Security or a pension. These sources can reduce the amount you need to withdraw from your portfolio each year. By supplementing withdrawals with Social Security or other income sources, you can ease the pressure on your portfolio. This may allow you to stretch your savings further and possibly even withdraw less than 4% each year. Healthcare costs can be unpredictable, especially in retirement. It's wise to set aside funds specifically for medical expenses or unexpected needs to avoid drawing too heavily from your portfolio. Having an emergency fund or a designated healthcare fund can help protect your retirement savings. This way, unexpected expenses won't force you to withdraw more than 4% from your investment portfolio. The 4% rule and early retirement. If you're planning to retire early, say in your 40s or 50s, the 4% rule may need to be adjusted because it was originally based on a 30-year retirement period. For longer retirements, a lower withdrawal rate, like 3.5% or 3%, might be safer. Early retirees have to make their savings last longer. By using a more conservative rate, you reduce the risk of running out of money. Adjusting for a longer retirement timeline helps create a more sustainable financial plan. Monitoring and adjusting your plan over time. The 4% rule isn't set in stone. As your lifestyle or financial situation changes, revisit your plan regularly. You may find that you can adjust your withdrawals based on how well your portfolio is performing. A flexible approach helps you respond to market changes and personal needs. Regularly reviewing your finances ensures that you stay on track and make adjustments as necessary to keep your retirement plan sustainable. Is the 4% rule right for you? Finally, remember that the 4% rule is a guideline, not a one-size-fits-all solution. Depending on your goals, lifestyle, and risk tolerance, it may be helpful to tailor your withdrawal rate or consult a financial advisor for a personalized plan. The 4% rule can be a powerful tool for planning retirement, but it's not the only approach. Understanding your unique financial situation and being open to adjustments can help you create a retirement plan that truly works for you. And there you have it, a complete breakdown of the 4% rule and how to implement it. This rule is a fantastic starting point for planning your retirement, but remember to adapt it to your own needs and goals. If you enjoyed this video, please like, subscribe, and let us know in the comments how you're planning for your retirement. Thanks for watching, and see you next time with more money in your pocket.